Hey guys, how's it going? In today's video, I want to talk about Goodwill. I got the Aurora cannabis booklet for the merger with Metroleaf, and I thought I'd talk about it because I found some interesting points in it. And so I noticed that once this merger goes through, Aurora would gain like $3 billion of goodwill, or $3 billion of goodwill if you combine it with Canamed. And I found a video, and this is the best video that I found that will explain what goodwill is. So and I'll comment along the way. I have stuff loaded up so I can kind of explain. So let's begin.
The other day, and I see this thing called Goodwill, right? And I'm like, what does that mean? Is that like the amount they're gonna donate to charity or something? So I read up about it. It's totally not the case. As it turns out, Goodwill is something that gets calculated, and it only comes into play when one company buys another company. And it's kind of interesting when you break it down, because even though it sounds like a good thing, well, I don't know. It's kind of up for debate. So, but first, let's do a quick review of the balance sheet. So remember, we got three sections: assets, liabilities, and equity. Assets are stuff that you own. Liabilities are stuff that you owe to other people. And if you take everything you have and then subtract everything you owe, what you got left is your net worth, which is also called equity. So that's the basic accounting equation. And usually I like to rearrange it like this, with assets on the left and liabilities and equity on the right. Alright, so where would you find goodwill on this? Well, it actually goes in the asset section, but you'll only see it there if the company has purchased another company in the past. So let's take a closer look at the different types of assets that a company might have. Alright, well, first we have tangible assets. So this would include stuff like cash, accounts receivable, any type of financial assets. And it would also include physical stuff like, equipment, property, inventory, anything you can touch. So tangible assets are just anything physical or financial. And these type of assets are usually a little bit easier to understand, and it's not too hard to figure out what they're worth in the market. But then on the other side, we got intangible assets. So this kind of stuff is like patents, trademarks, software, secret recipes, even customer relationships. So these intangible assets are things which have value, but they're not physical in nature, and they're not financial instruments. Sometimes it's harder to recognize these assets, and it's harder to assign values for them. But I mean, at least we can identify these assets and try to assign some value based on some estimate of how much money they might make for us in the future. Alright, so everything we've listed so far, let's call these the identifiable assets. And let's just say, for the sake of example, that these all add up to $1.5 million. Alright, now let's say we're looking at buying this company. Now, there could be some other stuff, there could be some other intangible stuff that we may want to think about. So what do I mean? Well, maybe they got a really good reputation. Maybe they got awesome employees. Or maybe this company has a product, but if we put it with one of our products, then we can combine them into some kind of super awesome product and just dominate the market with it. They call that synergy. So maybe that potential for synergy could be another one of these things, one of these intangible things that we think about. But again, it's hard to assign values to this other stuff. But, we're pretty sure that we're willing to pay more than $1.5 million to buy this company. Because we have a good feeling about this other stuff. We think the value is more than just the sum of the identifiable assets on paper. So let's say we think it over and we decide, okay, you know what? Instead of 1.5, we're willing to pay $2 million to buy this company. So it's like, I see your $1.5 million in identifiable assets, but I'll raise you an extra $500,000 for this other stuff that I have a good feeling about. And that's really where the goodwill comes into the picture. So let's say we end up making the deal for $2 million. Well, that extra payment of $500,000, that becomes the goodwill.
Aurora. I have Aurora loaded up here. Is this Aurora? Yeah, okay, it's Aurora. So they have $883 million. They paid $1.1 billion for Canamed. So Canamed's total asset was like 200 million ish or whatever. And then you subtract that and you get left over with $883 million of goodwill. The goodwill would be, you know, future growth, clients, the customer base, you know, supply deals, like intellectual property, like information can be valuable, but it's all, but the thing is, like, it's intangible assets, so that kind of stuff. Let's and I guess that's where the goodwill comes from. Let's continue the video.
So after we consolidate both companies, now when I look at the assets section of my balance sheet, we should see a line called Goodwill with $500,000 in it. Alright, cool. Let's look at an example. So here's the balance sheet for Facebook back in 2014. So we could see stuff like cash, accounts receivable, property, and here's the Goodwill line. And the number is like 17.9, almost $18 billion. Oh my goodness, yeah. These numbers are in millions, by the way. So that is a whole lot of goodwill. How did that number get so high? Well, remember that goodwill only comes into play when a company buys another company, so this means they must have bought somebody. Well, who did they buy? Actually, Facebook's bought like quite a few companies, but one of them is called WhatsApp. And we can look at the specific numbers behind that deal. So how much did they pay for WhatsApp? Well, that's this number right here, total fair value consideration. And it looks like they paid over 17 billion. We can look at the breakdown here and see what kind of assets WhatsApp had. So they've listed a couple. We got users, trade names, technology. So we can add up these assets and subtract the liabilities, and we get net identifiable assets of around $1.8 billion. Okay, but they paid over 17 billion for them. So let's do the math on the goodwill. So we take the purchase price and subtract the total value of net identifiable assets, and we end up with a goodwill of over $15 billion. So I mean, that's a pretty big number. I mean, the biggest chunk of that entire purchase is goodwill. So it's like Facebook, you know, they looked at WhatsApp and said, hey, I see your $1.8 billion in net identifiable assets, but I'll raise you $15 billion on top of that for this intangible other stuff that I think, you know, is going to be valuable. You know, so how does Facebook justify that purchase? Well, let's see what they say about it. So these are their words. So expected synergies, potential monetization, strategic advantage, expansion of mobile messaging. Okay. I mean, do you think that's worth 15 billion? I don't know. Maybe it is. Like, how are they going to monetize? Are they going to start charging people?
Look at Facebook's financial today in 2017 or 2018. You see goodwill as 18.26. It really hasn't changed very much for a while now, because they haven't really acquired any company after WhatsApp. WhatsApp was basically the biggest company they acquired. Instagram, they paid $1 billion for that, and WhatsApp was like 17 billion. I guess the goodwill was like $15 billion. And then the total assets only $88 billion of a company that's worth $500 million. Seems a little overinflated to me, but when you take into account for goodwill, yes, it's like a horrible number, but there was a lot of synergies. If they didn't acquire WhatsApp, they wouldn't be able to have a successful Facebook application, because back in the day when Facebook started out, they had a problem going mobile. They didn't know how to at first, but once they acquired Instagram, once they acquired WhatsApp, they also obtained the talent to create a mobile Facebook app. So the synergies between the purchase of Instagram and WhatsApp helped make Facebook great. At least it's just this is my theory. I guess we'll continue the video.
People to use WhatsApp, you know, are they gonna start putting ads in there? You know, are they gonna start using WhatsApp for mobile payments? Are they gonna put, you know, chat bot functionality in WhatsApp? You know, maybe they just want to buy WhatsApp to, you know, not have to compete with Facebook Messenger. I mean, I don't know. I'm just making this stuff up, right? It's pretty vague, and I guess that's the point, is that's kind of hard to tell. You know, but there is a lot of potential. I mean, a lot of people do use WhatsApp, so maybe Facebook will eventually be able to turn that $15 billion that they spent in Goodwill into profit. But what if it doesn't turn out as planned? Like, what if all of a sudden WhatsApp gets hacked and there's like this big security leak and everyone just stops using WhatsApp and starts using WeChat instead? Well, if Facebook can no longer expect to turn the profits that they, you know, originally expected with WhatsApp, then now what happens to that $15 billion Goodwill asset on the balance sheet? Well, that, you know, technically they should reduce the value of that Goodwill asset, and this process would be called Goodwill impairment. And technically, public companies are supposed to check at least once a year if they need to do this. So say maybe Facebook needs to take that $15 billion number down to $10 billion. Okay, so sure, they can reduce that number on the balance sheet, but on the flip side, there's actually another consequence. So I don't want to talk about the income statement too much because we'll do it in a different video, but the income statement is where companies report profit. And if you reduce the Goodwill number on the balance sheet, that also needs to be recorded as an expense on the income statement, which has the effect of reducing overall profit. So say, for example, Facebook was originally going to report $6 billion in profit for the year, but then they have to do this Goodwill impairment for $5 billion. Well, now that reduces their profit down to only $1 billion. And that doesn't look as good to investors, so companies tend to not really want to do this Goodwill impairment thing too often. All right, cool. Let's summarize. So Goodwill is only
risk of Goodwill. If the company they acquired doesn't pan out and they have to reduce that Goodwill down, it would take a hit out of their profits. But if the company is still good and still growing, and they don't have to reduce that Goodwill, then it's fine. At least according to this video, anyways. According to all the videos I watch. So Goodwill is good if the company is growing and helping the main company, you know, grow bigger, then that's good. That's good. But if the company is failing, like let's say, I don't know, a building burned down, now the Goodwill has to drop down, and then it takes it from the profit of the actual company, which is bad. I guess we'll continue the video.
only recorded on the balance sheet when a company buys another company. So if you're looking at a balance sheet for a company that's never bought another company, then you shouldn't see a goodwill line. The goodwill from a purchase is calculated as the difference between the total purchase price and the net identifiable assets. Goodwill is recorded as an asset, but it is intangible. It's not separately identifiable. It's highly subjective and really difficult to value. And so it's really hard to know if you're getting the number right. So the next time you see a really big number in the goodwill line, I mean, just remember that it's not really a hard asset. And you gotta ask yourself, like, how is this company actually planning on turning this number into real cash in the future? Alright, cool. Thanks a lot for watching, and yeah, see you in the next video.
financials, I guess. This is the Metro Leaf. So if you look at the total assets, it's about 3.57. You minus the total liability, which is 30 million, and you get 328 million dollars in equity. So Aurora paid 3.2 billion dollars in stock to purchase a company that has 328 million dollars in asset. So Aurora has to use that company, or the assets that the company has, which is right now is Goodwill, and they have to turn that Goodwill into profits in the future. If they fail to do that, that's the risk. So if they fail to achieve that $3 billion within, I don't know, like the 5-10 years down the road, then that's definitely a risk for the Goodwill. At least this is how I see it. Okay, I guess that's all I really have. Goodwill is still kind of hazy, and I still don't 100% understand it, but I understand a lot better now than I did, I don't know, let's say an hour ago when I was just learning this stuff. Well, anyways, thanks for watching. I hope you guys learned something new from this. I definitely did. So, yeah, have a great day. Subscribe for future updates and give me a thumbs up if you like this video. Bye.